Hello, everybody. It's Hammer, and we are here this week with your mortgage market update. And I am joined today on November 2nd with today's guest, Jason Sharon, who is a mortgage broker out of Charleston, South Carolina. Jason, please take a minute, introduce yourself, tell everybody a little bit about yourself.
Hey, great. So Jason Sharon here, Home Loans Inc., a small little mom and pop boutique brokerage in Charleston, South Carolina. Specialized in VA loans, licensed in most of the Southeast.
Awesome. You can tell everybody that you've been quoted in Yahoo Finance and all. What are some of the other places that you've been chatting on lately?
Yeah, so in the last 12 months, The Hill has quoted me twice, Yahoo Finance 4 times, Money.com twice, and I've been in Forbes.
Yeah, so we've got ourselves a celebrity. You're almost up there with Beyonce. So, all right, everybody. Today, though, of course, November 2nd, and we are going to be talking all about rates and pricing and your mortgage rates. Again, this is Jason Sharon. So if you're here live, do us a favor. Go ahead and let us know that you're here. Say hello. Be a part of the conversation. Ask any questions. Share your thoughts. If you're watching on the replay, do us a favor. Give us a hashtag replay. Let us know that you were here. We do monitor the posts. So if you have any questions from today's session and you want to put that on the replay, we will be more than happy to answer those for you as well. And let's go ahead and jump in, and we'll start with a rate recap. So mortgage rates last week actually did improve a little bit, which was nice to see. Jason, what did you see on your rates for most of your borrowers? Did you see
it was a welcome tall glass of cold water last week. We needed it. It was it's been so brutal for the last month or two that just having a little bit of breathing room like what we had last week was so nice.
Yeah. And again, so this is not an offer to lend when we talk about rates. We're just trying to give you guys an idea of what we're seeing out there and overall trends. Of course, you want to work with your own vetted professionals so that you can find out for your unique situation. It's always the best way to go about anything. And it's never too early to talk to a mortgage loan officer, a mortgage originator, mortgage broker about your unique situation. If you're considering it, you're not wasting anybody's time. Reach out early and chat with them. They'll be able to help get you in the right place to do something. So overall, I think we've seen rates going up since the end of July. It seems almost week after week after week. We saw rates that were in the 5s push up into the 7s. A lot of VA loans were still in the high 6s. What are you seeing as just a general average for VA mortgages and conventional conforming loans? What are you seeing for rates these days for those people that are watching?
So the government loans, VA, FHA, USDA, I'm generally seeing in the mid 6s, maybe a little bit low 6s, maybe high 6s for someone sub 660. But if you got decent credit, you're going to be 6.5 or below. That's with no points, no fees, no underwriting fees, no nothing. So the APR should be very, very close to the rate. For a conventional conforming loan, you're probably looking at something in the low 7s, again, with the APR being very, very close to the rate with no additional fees or points or anything.
Yeah. So, and remember, it's one more reason why you want to check into using your VA benefit if you do have entitlement, because you are going to find that you're going to see a better interest rate than many of the conventional conforming loans, or what we call Fannie Mae, Freddie Mac loans. So anyway, that's a quick recap on kind of what happened last week. It was some improvement. Would you say, I mean, it wasn't big improvement though, maybe 1/8 of a point or possibly a 1/4 point for some borrowers, maybe some borrowers only seeing some improvements to their closing costs. What did you see on average, do you think, last week for?
I think you're about accurate. 1/8 of a point plus or minus. Some of them, if it was a very, very large loan amount, you didn't see a change in rate. You just saw instead of maybe costing $500 to get that rate, maybe you got a credit of $1,000. So your closing cost improved, which
Awesome.
was a nice change.
We have Facebook users.
Less change compared to just losing every day.
See them creep up like a death by 1,000 cuts like it's been. So someone said, thank you for this. You are welcome. It is great to see all of you here. So let's go ahead and talk a little bit about rate forecast. So everybody wants to know, rates are ready to drop back into the 4s probably next week, right?
Oh, absolutely. No, the talking heads that I follow, like you and the other industry individuals, and even I follow a lot of non-mortgage industry to understand, to get some other perspectives, not just narrow focused on us that are in this every day. Should start seeing some rate improvement, Q3, next year, based on, as you probably know, this is the first year, or this year, both bond and stock market will end down. That's only happened a handful of times since World War II. And every time that's happened, bond yields have improved dramatically the next year, and therefore you see mortgage rates come down significantly next year.
Yeah, so that's a question we get a lot. Are rates going to improve? Should I wait for rates to come down before I buy a home? Rates are going to improve, but they're going to improve probably, as you said, Jason, towards the end of 2023, maybe, the third quarter, fourth quarter. We'll talk a little bit more about why that is, folks. I want you guys to be educated. It's important to vet a VA and Christopher and Nathan in the community. So we're going to tell you why we're not going to see them drop really significantly until then, but they are likely to drop. But like we said, it's going to be Q3 or Q4 of 2023 before we see really significant movement. And let's kind of talk a little bit about why that is and why we expect rates to go down, and also why we don't expect them to go down until then. So today actually is a Fed meeting day. So we're gonna circle back on that. Oh, you've got fire engines over by you. I don't have those in the Smoky Mountains. We have bears. they carry buckets and put out fires. And he tells you only you can prevent forest fires. We have that bear. But anyway, today is the Fed meeting, and the Fed activity has been why we've seen mortgage rates increase along with inflation. So inflation, as we've talked about many, many times, has been a very big issue, and inflation still, not rising necessarily, but still extremely high, much higher than what the Fed and what the rest of us spending money actually want to see it as. Sorry, that was my hand on there. So inflation has been a big issue. And in order to fight inflation, what we need to see happen is the Fed is raising what's called the Fed funds rate. So they're raising their policy rates, we're going to call them. And the Fed has raised that rate starting in March. And in March, they raised it by 0.25%. Now, before that, because of COVID, they had actually lowered that rate because they were trying to keep the economy going through the pandemic. And that was, of course, for the circumstances, that was the number one priority. Problem is, now that we've come through the pandemic, the economy is humming along, and they need to slow it down because it's running too hot. And that's why we've seen all of that inflation. So in order to slow the economy down and fight inflation, the Fed starts to raise rates. Now, they don't set mortgage rates, but mortgage rates will go up as the Fed raises other rates, specifically the Fed funds rate. So they raised in March. They raised again in May, and they did a 0.5 point that time. And then in June, they started to really swing the bat, and they went to 0.75 point rate hikes. And we saw one in June. We saw one in July. We saw one in September. And today, what do you think the Fed will do today, Jason?
I firmly believe it'll be another 0.75% today.
Yeah, it's very likely to be 0.75. In fact, I'm going to jump over a screen. I want to show you all. I show this to you guys almost every week. These are Fed futures. The markets are betting on where they think the Fed is going to go ahead and put rates towards as we go through the next few meetings and in the next few months. So right now, it is a 90% belief, a 90% probability that we will see those rates go from 3.00, which is where they're at right now, to 3.75. And they actually use a range. That's why you see it like this, but we're going to call it 3.75. Now, today, we could see mortgage rates either get better or worse, but it's not going to have anything to do with the Fed raising rates today. Believe it or not, that has already been accounted for. We've talked about this before. Mortgage rates are basically reacting to the expectation of future Fed actions. So it's what we think is going to happen at these meetings that come up in December. We've got our next meeting December 14th, so about 6 weeks from now. Then we have another meeting February 1st. March 22nd, May 3rd. So right now, you will see mortgage rates either improve today or get worse today. And it's not going to have anything to do with the fact that the Fed actually raises the rates today. What we're going to be looking for is at 2 p.m. today, the Fed is going to release a policy statement. And in that statement, they're going to make comments about what direction and how aggressive they're going to be in needing to hike rates at those other meetings we talked about, the ones in December and February and March. So if the Fed looks like they're going to kind of slow down from these aggressive rate hikes where they've been raising by 0.75 each meeting, June, July, September, here in November. If it looks like they're about to kind of slow down from that, and maybe only do 0.5 at that December meeting, and then maybe 0.25 at that February meeting. If we see the expectation that the Fed will take a lower, slower path of rate hikes and will stop hiking rates once they hit maybe 4.5 or 4.75 on that Fed funds rate, that's going to be good for mortgage rates today. We will actually see rates improve, and they're not going to improve tremendously. You're not going to see rates go from, let's say, if you were quoted a rate yesterday of 7%, it's not going to go to 6%, but it might go from 7% to 6.875 or 6.75. So there is some room for rates to improve, but we're still likely to see rates that are generally going to stay within the sixes. That's probably where we'll be until we get into that mid 2023 mark that we talked about. Now, if the Fed, however, gives an indication that they're going to need to be aggressive and that they have to stick with these aggressive rate hikes because they're not seeing enough movement with inflation, which we haven't really seen, then what would happen is we're going to see mortgage rates react today. So I'm going to say react today. And what they're reacting to, again, is not today's actual Fed rate hike. It's the expectation of where we will be in December. So right now, we know we're going to go up to 3.75, or let's take that as a given that we're going to go to 3.75. We have a 90% expectation to do that. So from 3.75, if they go a half a point, it would take us to the 4.25. If we go another 0.75, it will take us to 4.5. This morning, these Fed futures were trading. They were almost 50-50. It was like 48%, 48%. Right now, we're seeing a little bit more of a momentum that markets are pricing in that we'll see a half a point rate hike in December. Again, if the Fed starts to reduce these rate hikes, they're still hiking rates, but mortgages have already reacted to that news. So if we see this go up higher after today's comments and after today's press conference from Fed Chair Jerome Powell, and if we see the expectation that the Fed will be less aggressive hiking rates, that's going to help your rates, your mortgage rates for the next couple of days, and we'll see things improve a little bit. However, if you are currently under contract and you are not yet locked in, stay in touch with your professional today, because if we see a negative reaction, which is what happened in September, and let me see if this will cooperate today. It wasn't working for me the other day, so I was trying to do prior hikes. In September, what happened was we actually got a much where do I go with this? It was not very well received. We got a message from the Fed. Go ahead. You know what I'm going to say.
Jerome Powell was very hawkish.
Yeah.
He was very, and he just came out and said they are prepared to do whatever it is to make sure that the job is done properly. Is what came out. So at that point, everyone was him and hawing. Oh, it's not going to be so bad. And then Jerome Powell just sucked the air out of the room.
He just slapped him. He was like, everyone's like, the Fed's pivoting. We're going to slow down. And that's kind of what we're seeing right now, was that same sentiment. But we saw this before the September meeting, and the Fed was like, no, we're not. And then everyone was like, what do you mean you're not? And then they all freaked out, and we saw mortgage rates get worse. Boom, instantaneously, we see rates, react negatively, and they go up. Now, they're not going to go up from 7 to 8, but they might go up another 1/8 of a point or a 1/4 point. But today, I think we're going to see that pivot or that downshift today. That's what I think is going to happen. What do you think is going to happen, Jason?
I haven't seen anything from the Fed stating something different than what they said in September. And you see a lot of this time, or this quarter, this 6-week cycle, you're actually seeing political proponents getting in. You're seeing senators and representatives and governors and such getting involved and making public statements to try to pressure the Fed. So it seems like there's nothing out there that would make me feel it's going to be any different than September. Yeah, inflation is not growing as fast, but it's still, unemployment's still low. We're not seeing an upturn in unemployment. My hope is, he comes out and says, oh, everything's hunky dory, but I'm not an optimist like that.
Okay, I'm going to show you why I think things are going to get better for those of you that are watching. So this one gets a little bit of put on your aluminum foil hat, but the Wall Street Journal is kind of the unofficial mouthpiece of the Fed. When they want to get a message out there, they generally will release it to the Wall Street Journal, almost like a leak, in order to get their message out in front of the markets. And they like to use an individual by the name of Nick Tamaris. And Nick did an article here on October 21st, I think was the first one. So this was the first article. The Fed set to raise rates by 0.75, debate the size of hikes. Now, one thing for everybody to note is that the Fed will actually they have a blackout period in order to not manipulate or affect markets. So the Fed will speak all through the month or months before a Fed meeting. But about 10 days before the meeting, it's the Saturday before the Saturday, they are on a blackout and none of them are allowed to come out and make any public comments. So for those 10 days or so, it's a blackout period in order to not influence things, but it creates a void. And the Fed will use the Wall Street Journal and they'll use Nick Timmerus to get this message across. And the message they put out there, they first put it out there by the 21st. And this is kind of the thing, right? Some officials are signaling greater unease with big rate rises to fight inflation, and that they're debating the size of the future hikes. And those are the ones we talked about in December and February. And again, that's going to affect your mortgage rates today. Now, the next time that they put an article out there was on the 31st, on Halloween. He was on the Wall Street Journal's podcast with the same message. And then yesterday rather, it was on today's print edition. He put out another article, the Fed meeting to focus on interest rates coming path. Another 0.75 point hike rise is likely this week as the pace of future moves takes the spotlight. Now, the fact that I'm seeing what they call the Fed whisperer or the Fed mouthpiece, and he has made so many, 3 different things out there, 2 articles and a podcast about this. I think that this is the Fed behind the scenes kind of manipulating what's going on and getting across to markets that they want to slow things down. And the reason they're doing it this way, they don't want markets to get too jubilant. If they come out and say, yes, we're ready to start slowing things down, then the stock market's going to take off. And if the stock market takes off, that heats up the economy, which is the opposite of what they're trying to do. And if that happens, then they're going to have to go the other way and they're going to have to be even more aggressive and tighten up again. So they're trying to play this balancing act. And I think this is their way of doing that. What do you think? Do you think should I put on my aluminum foil hat, or do you think there's some merit to that?
No, it sounds wonderful. I was not aware of that article on the 21st. But I would say you take for face value. We would expect the Fed to always be considering the future rate. I mean, that's if they're not considering it, then they're not doing their job and they're idiots. And obviously these guys are brilliant individuals that know significantly more about economics than you and I put together. So I would say those words are exactly what we would want is they're having a good discussion about the future, not just saying it's going to be 75 bips or not just saying it's going to be 25 bips, right. that they're going to have a healthy discussion and observance of what's happening in the market. But as we know, the things they do today take, months to, weeks or months to actually have an effect, trickle down effect on the actual economy, like trying to stop a train or trying to turn an aircraft carrier. It just doesn't happen that quickly.
Yeah. Yeah, very much so. So anyway, for those of you that always ask and you say, okay, well, where are rates going and what do you think is going to happen? We think that today is a pivot point. We need to be reactive. So if the Fed does give the perception to the markets that they are slowing down and that we could see less aggressive Fed rate hikes heading into 2023, and that we could see a lower what's called terminal Fed funds rate, meaning how high are they going to take this? There's expectations they could take it to 4.75 or 5 or 5.25. And the higher they take this Fed funds rate, the higher mortgage rates are going to be before they cap out as well, before we hit that ceiling. So right now, the expectation that we should see something around 4.5 to 4.75. If we get into that expectation of more of 5.25, 5 to 5.25, then we're going to see mortgage rates move up a little bit higher as well. Again, in anticipation of what's going to happen months from now, but we're going to see that in mortgage rates today. But if we do see the idea from the Fed that things are going to slow down, then we'll be in a good place. And then that'll actually open the door for interest rates to improve a little bit. But again, I don't think we're going to see any huge moves in interest rates, any huge improvements. Certainly no reason that you'd want to slow down from house hunting or considering buying a property. What do you think, Jason?
Oh, absolutely. I'm telling everybody that our purchase today, that you only have that loan for 12 to 24 months. Your rates will be lower in a year and a half or so, and we're going to do refi. So don't spend extra money in points. Don't do prepaid PMI. Don't do anything silly, because that loan is not going to be there. Now, you're just not going to have that loan for that long. So it'd be a waste of money. The other thing is to be aware of as a consumer is, as the market allows rates to come down, mortgage rates to come down, lenders are going to be very sticky as far as dropping the rates over time. They're not going to, if the bond market significantly improves and there's room for a lender to drop their rate, they're going to be less likely to do that. One, because they're going to be worried about a whipsaw, because the mortgage volatility rate right now is as high as it's been since COVID. And I don't think it's been higher than that before COVID. So it's very volatile right now. So they're worried about locking a lower rate and then not being able to fulfill that rate, or cost very a lot to fulfill that rate later when they close. And the other part is, the lenders are hurting right now based on the amount of volume versus the amount of expenses they have based on employment. You've probably seen a ton of layoffs in the mortgage industry. Lenders need some liquidity. So I think even as rates come down, lenders aren't going to be as quick to lower rates, so that way they could refill their coffers with a little bit of reserves, with a little bit of cushion there. So that way, if we do have another whipsaw, they're not hurt as bad, and not as many will go out of business, because we've seen so many go out of business this year.
Right. And that's what I'm going to wrap up with, kind of touching back on what I said earlier on today's session. And you kind of went there just a minute ago, is that lenders have, they have these margins, they have these expenses, they're trying to maintain their staff. And when they can't maintain their staff, they're doing layoffs. In the mortgage industry, this is where we are similar to 2008. Even though we are not in a housing bubble, we are very, very unlikely to see a housing crash. We've talked about this, all the last few sessions. I asked Jason about this ahead of the call. Jason, you said that you don't think there's a housing crash, right? Is that what you?
No, there's so much demand.
Yeah, still too much demand, not enough supply. And that we talked about normally when rates would go up in this ridiculously quick way that they have, we would see home prices start to drop. We would expect to see that. It would happen very quickly. We would see prices drop. And again, we wouldn't lose tremendous amounts, but they are going to go back a little bit. But this time we're not seeing that. And that's because there's not enough supply and there's still too much demand. Even though that demand has been reduced, there's still not enough supply. And when you have people with 2 or 3% interest rates, 3.5% interest rates, normally if rates go up at a gradual pace, people are going to move. We have children, we upsize, we downsize, we move across town, whatever reason, people move. And that is what keeps that natural ecosystem of housing going. Well, right now, when rates have gone from 3.5 to 7.5 or 6.5% even, people aren't going to just make that move from a smaller house to maybe a bigger house with more bedrooms because they have that new baby. They're going to say, well, I don't want to take on or can't afford a $600 or $700 increase in my mortgage payment. So we're going to stay put, and the kids are going to have to share a room for a while. And that's what we're seeing. And we're seeing that. And that's what's keeping the housing market propped up, which is keeping the values there. So anyway, what I wanted to go with the 2008 thing, though, and talking about mortgage companies, we're leading the economy on this. We're starting to see a lot of mortgage people, unfortunately, getting laid off. And that labor market is people getting laid off is what drives us into the recession. It's really the truth, because people aren't making money, so therefore they're not spending money. Our economy is a consumer spending economy. So this is all why we think that in 2023, we will see rates go back down, because right now the Fed is really, really, really applying the brakes and trying to slow the economy down, but they're going to need to then resuscitate it, because what's going to happen is when you slow it down, people are going to start to lose their jobs. We're going to see the labor market affected. When that happens, we will see less spending. Inflation comes down because there's less demand for products. You have more supply. That means things go on sale. I was in Home Depot yesterday, November 1st, and they have all month Black Friday sales. Black Friday turned into Black November. And that's because retailers know where we're headed and they're trying to get the dollars as fast as they can, right? They're being aggressive out there. And that's why we think that rates will go down in 2023. Would you agree with that? Anything you would add to that?
100%. You're exactly right.
Yeah. So, and it'll be funny because we have a big jobs report that comes out on Friday this week, but because it's so quickly after this Fed meeting, and there's going to be another report that comes out before the next Fed meeting, it's less likely that we'll see a very strong reaction to this jobs report that we're going to see, and it'll probably be a pretty strong report because we still see a pretty healthy job market. There's a lot of demand for workers out there, still struggling to get enough people. You still see those signs, hey, be nice to the people that are working because they're actually working. Like, I don't know if you see the signs around you. We get to see the signs all over here all over the time because everybody's aggravated. They got to wait, so anyway, well, is there anything you want to leave everybody with before we wrap up, Jason?
Just keep your heads up and keep pushing along.
Yep. So, well, thank you for joining us. Remember, everybody, you can join us next week. We can go over this each and every week. Let me see. I'm going to my slides here, and I'll show y'all. We do this 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And if you guys have any questions, please put them in the comments. Otherwise, if you are watching on the replay, don't forget to go ahead and give us a hashtag replay. Let us know that you were here. If you're here live, say good morning before we wrap up. Otherwise, we'll see you next week. Take care, everybody.